Millions of investors wait all year for a single notification on their phone. It's the alert that a dividend has been credited to their account. Money appearing in the balance without selling a single share. It's often celebrated as the ultimate form of passive income. But that notification signals a trade-off that most investors never calculate. Behind that credit is a mechanism of corporate debt and taxation that can quietly erode the wealth-building engine of your portfolio. For 2 decades, global finance operated under artificial conditions, interest rates at or near zero. That era of free money has ended. Today, major governments are carrying historically high debt loads, forcing them to offer higher yields on bonds to attract capital, which in turn raises the cost of borrowing for every business in the economy. This shift has pushed up the WACC, the weighted average cost of capital. In this environment, a company's own earnings are its most valuable and cheapest source of funding. When a company pays a dividend, it drains that internal cash and is often forced to replace it with expensive external debt just to maintain operations. The corporate cost is only the first hurdle. Once a dividend is declared, it enters a systemic framework known as double taxation, where the government claims a portion of the same profit at 2 different levels. Consider a $100 block of corporate profit. Before you see a cent, the government takes its first slice in the form of corporate income tax. The remaining profit is then distributed to you. At this point, the government taxes that exact same money a second time as your personal dividend income. This chart shows the impact of this dual-layer tax across 3 different countries. In the UK, Germany, and Pakistan, the combined effect of corporate and dividend taxes can leave a high-earning investor with less than 48% of the original corporate earning power. By the time that dividend hits your account to be reinvested, more than half its potential to compound has already been removed by the state. Warren Buffett has spent 6 decades warning investors about this specific inefficiency. Since 1964, he has grown Berkshire Hathaway's book value by over 5 million%. He achieved this growth while almost never paying a dividend, preferring instead to keep every dollar of profit inside the company. Buffett's logic is simple. A company should only retain capital if every dollar kept creates at least $1 of market value for the shareholder. If a business can reinvest its own profits at a high rate of return, keeping that money is the most efficient path to wealth. When an investor forces a quality company to pay a dividend, they interrupt that internal compounding. The investor pays immediate taxes on the payout, and then faces the difficult task of trying to find a new investment that matches the return of the company they just drained. In 2012, Buffett proposed an alternative, the synthetic dividend. In this chart, the steep line represents a company that retains all earnings to compound tax-free. If you own this company and need cash, you don't wait for a dividend. Instead, you sell a small percentage of your shares, for example, 3%, annually. Because the company's value is growing faster without the dividend drain, selling those shares can provide the same annual cash flow. Crucially, you only pay capital gains tax on the appreciation of the shares you sold, rather than income tax on the entire cash distribution. This strategy helps avoid a subtle but destructive force in wealth building, dividend tax drag. If your portfolio has a 2% dividend yield and you pay a 15% tax on those payments, your annual growth rate is reduced by 0.3%. While 0.3% seems small, this chart shows how it compounds over 30 years. That tiny annual tax results in a 19% gap in total wealth by the end of the period. On a portfolio worth $10 million, that is a $2 million loss to tax drag. For investors in the accumulation phase, dividends act as a constant drag on growth compared to the tax efficiency of a sell-off strategy. The math behind the synthetic dividend strategy holds up during the years you are building wealth, but the logic changes the moment you transition into retirement. Retirees face a specific threat known as sequence of returns risk. When you are withdrawing money, a market crash at the beginning of retirement is far more damaging than a crash at the end. This graph shows what happens if you rely on selling shares during a 30% market crash. To get the cash you need for living expenses, you are forced to sell more shares at the bottom. This leaves you with a smaller stake to participate in the eventual market recovery. Selling into a crash at the start of retirement can deplete a portfolio so significantly that the principal may never recover, even if the market later hits new highs. This is where dividends serve a different purpose. They act as a structural shield during periods of high volatility. A portfolio of mature, high-quality companies that continue paying dividends allows a retiree to collect cash flow without touching their underlying shares. The market price can drop, but the income stream remains, protecting the principal until prices recover. There is also a psychological benefit. Receiving a steady check regardless of market fluctuations helps investors avoid the panic selling that often occurs when people see their account balances drop. Ultimately, dividends are tools with specific uses. If you are building wealth, avoiding them minimizes tax drag and maximizes compounding. If you are living off your wealth, they provide the stability needed to survive market downturns.